Today, we're going to be taking a look at an ETF that's up over 20% this year. This is far ahead of funds like Vanguard's VOO that tracks the S&P 500, which is up 10.10% year to date, or Invesco's NASDAQ 100 ETF, which is up 11.89% year to date. This fund that we're going to be taking a look at today that's outperforming in 2025 is SPMO, Invesco's S&P 500 Momentum ETF. I'm going to explain how it works, how it compares to other funds in more detail so that you can decide if this is something that fits into your goal. From the numbers that I've already shared, we see that SPMO is leading compared to these popular funds, VOO and QQQM. And why is that? SPMO takes the S&P 500 and focuses on the top 100 companies with the strongest price trends over the past year. They drop off the ones that aren't keeping up. It's a simple way to ride the wave of the performance of those winners. It adjusts twice a year in March and September, skipping the last month's price jumps. So looking out a little further, over the last year, it's up 31.12%, and over the last 5 years, it's up 128.9%. We're definitely seeing steady growth here. And the top 10 holdings in this fund are NVIDIA, Meta, Amazon, Broadcom, JP Morgan Chase, Tesla, Walmart, Palantir, Netflix, and Costco. Looking at SPMO against those two funds that I've been mentioning, VOO and QQQM, we can see that when those other funds take a hit, so does SPMO, but it holds up well. Its drops are similar or even better than the S&P 500 during those rough patches. This year, spring dips saw SPMO fall about 1% more than VOO, but the gains since then have more than covered for it. In past downturns, it has stayed ahead, showing it can handle pressure. With about 100 stocks compared to about 500 in VOO, it has a good balance, not too spread out, but not too risky. It has a mix that helps it to stay steady. There are going to be ups and downs, but from what we're seeing, we can expect better returns over the long term. So I am Lisa J. Stocks. If you're not already, subscribe, like, hit that notification bell, check out my referral link, and make sure to leave me thoughts concerning this ETF. Do you already hold it in your portfolio? Okay, now back to the detail. Next, we're going to be looking at some trade-offs to consider when it comes to this fund, SPMO. It costs a little bit more than VOO. Its expense ratio is 0.13%, $13 for every 10,000. While VOO is 0.03% or $3 for every 10,000 invested. That expense ratio is a fee that's associated with funds like this, exchange traded funds. So you'll have to evaluate if those fees are worth the growth potential. It also pays a lower dividend at 0.56%, about 85 cents per share, compared to VOO at 1.19%, and with an inception date 2015. So it has not gone through a true recession yet. And if those tech stocks that are currently thriving come to a bit of a slowdown, we might be waiting for a few months for the next rebalance to adjust and get those losers out of the mix. So guys, drop me some comments. Let me know what you think so far. But if you're focused on growth and can accept those risks, the higher returns would more than compensate for the increased fees. When it comes to this fund, I'll be keeping a close eye on it to see if the outperformance continues. Now, let me share my thoughts on whether SPMO could be a good fit for you. But first, let me say this is not financial advice. I'm just sharing my personal investing journey here. I have added this ETF to my portfolio recently. I only have 10 shares so far, and I'm up 1.49%, a very, very new addition. I'm going to continue building on it, and in the future, I will come back and give you a more detailed update on how this fund is doing in my portfolio. So this could be ideal for investors with longer time horizons, comfortable with a little bit of risk. If you have a growth-oriented portfolio, this could be one to add for extra growth, along with funds that track the S&P 500 or total US stock market, for example. So this might not be the right fit if you are more income focused, conservative, have a shorter investment horizon, or prioritize those fees and feel that that expense ratio is not the right fit for you. But for me, I think it will complement other funds in my portfolio and boost the growth potential. The way big tech and AI has been going strong, it gives this fund the potential to keep thriving the way that it has for the next few years. Now, let's go back to that rebalancing and talk a little bit more about it. An ETF like SPMO keeps its edge by tuning up its stock lineup twice a year. As I said, March and September. It picks the top 100 S&P stocks with the strongest price trends over the past year. It skips that last month to avoid any quick spikes and the focus on those current winners like NVIDIA. So in this process, they're swapping out those underperforming stocks, making sure to increase the allocation to those momentum leaders. This is a smart way to chase growth, but of course, past results do not guarantee future results. So by rebalancing, they're keeping the focus on what is working. And when I first started to dig deeper into the details about this fund, I actually thought the expense ratio was going to be higher than what it is, considering the returns. That's it for our fund's overview of the day. SPMO up 22.63% year to date, and there's still a few more months for a chance for more gains. So do you think that SPMO will keep going strong? Let me know in the comments, and let me know if there's any other funds that you'd like me to take a closer look at and share a deep dive on. Thanks for watching. I hope you enjoyed this video. Again, I am Lisa J. Stocks. If you're not already, subscribe, like, hit that notification bell. Check out my referral links. Continue to stay informed, learn, and earn together. Okay, bye.